Today, the COVID disconnect is back. Cases are exploding across the country and hospitalizations hit a record high. At the same time, we're seeing signs of a so-called return to normal in the Manhattan real estate market. Plus, the crypto craze is making a resurgence in 2020 as Bitcoin prices surpass $16,000. And finally, why one group of analysts is proposing a new tax on employees who choose to continue working from home even after the pandemic is behind us. I'm MacKenzie Sigalos, and this is CNBC After Hours. Stocks hit a rough patch today as all three major indices finished significantly lower. The Dow tumbled more than 300 points. The losses on Wall Street come as the coronavirus just rages across the country and economic growth slows. The U.S. reported more than 143,000 new COVID-19 cases yesterday. That's a record one-day spike. When we look at the 7-day average of new cases, they're 35% higher than they were a week ago. And it's not just cases. The 7-day average of hospitalizations is up by at least 5% in almost every state in America. There are more than 65,000 people currently in the hospital with COVID-19. That's the most yet, more than even at the peak of the spring outbreak in the Northeast. Former FDA Commissioner Scott Gottlieb told CNBC that 12,000 people are in the ICU, and some hospitals in states like Texas, Wisconsin, and the Dakotas are overwhelmed. All of this is terrifying. Experts have been telling us for weeks, months really, that the winter was going to be bad. One infectious disease specialist on President-elect Biden's coronavirus task force referred to the season as, quote, COVID hell. And now it's here. And the same experts say it's going to get worse, which is especially difficult to reconcile with the vaccine news that we got from Pfizer on Monday. So there is light at the end of the tunnel, but the last leg of the tunnel is going to be the darkest. We're already seeing new restrictions put in place. Detroit schools canceled all in-person classes until January. Chicago issued a stay-at-home advisory, asking residents to cancel Thanksgiving plans and only leave the house for school, work, medical attention, or groceries. And New York State is imposing a 10 p.m. curfew for bars, restaurants, and gyms as the pandemic gains strength. The state is also banning gatherings of more than 10 people in a private residence. But as New York navigates these new measures, New York City may be moving past the worst of the crisis, at least economically. The rental market is showing signs of life following months of pessimism. CNBC Wealth editor Robert Frank has those details.
Even as COVID cases rise nationally and in New York City, we are seeing a bright spot, one of the first for New York City real estate. Now, after a year of declining, new leases in Manhattan actually increased in October by 33%. And that was because rents now are down 19%. And that drop in rents was enough to bring young renters back into the city for the first time in months. We saw landlords now offering an average of 2 months free rent just to bring people back. Now, this is going to be a long road back for New York City real estate. There are over 16,000 empty rental apartments in Manhattan, and the vacancy rate, which normally in Manhattan is around 2%, is now over 6%. So this is going to be a multi-year comeback for New York City, but this is the first sign that maybe we're not seeing a rebound, but at least maybe we've hit bottom, and it could get better from here now that we have news of a vaccine and an election which could bring some stimulus dollars to New York City. Now, in Manhattan, rentals are really the most important part of the real estate market. 2/3 of all apartments in Manhattan are rentals versus to buy. Now, the other issue Manhattan faces is that it's still very expensive to rent. The average one-bedroom rents for $3,200 per month. Now, that is more than twice the national average. So yes, prices are coming down, but this is the largest rental market in the country. It is important, but prices are probably going to have to come down even further to bring all those people back. What's also happening at the same time is that these big tech companies, whether it's Amazon, Facebook, Google, They are putting tons of money into new space in Manhattan. And what that's done is created really a new generation of renter in Manhattan. So we're seeing the old guard of Wall Street in the Upper East and Upper West Side be replaced with a new guard of young tech workers. They want smaller, less expensive apartments. And the biggest activity right now is downtown. That's where the young renters want to be. So you've got a huge shift in terms of industries that dominate New York City real estate, from Wall Street to tech, and also from older to younger.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves.
In addition to getting the virus under control, which is of course job number one, it's getting the economy on a good track, which is equally job number one. So I don't know what we're going to see, but I do know that it's what the economy needs, and my hope is that that need is apparent to lawmakers.
When you're dealing with minus 75 degrees C, you're pretty much either dealing with dry ice or cryogenics. So the Pfizer solution is going to have self-contained packs that are packed with dry ice. What's very important is that you can extend the life of the dry ice self-contained containers by 2x if you put them in a broader container that's at minus 30 degrees C.
We have to make sure to care for the patients without COVID. We cannot allow what happened in March, April to happen again. We had delays in cancer diagnoses, people afraid of coming to emergency rooms. There's paper after paper and study after study to support that.
And I wanted to invest in something that wasn't sensitive to the economic cycle, that wasn't impacted by rising interest rates, that wouldn't be impacted by trade wars or currency crises, and just could withstand the economic cycle. That leads you to healthcare.
Stocks took a breather today, but crypto climbed even higher. The price of Bitcoin crossed above $16,000 today, hitting its highest level in almost 3 years, since January 2018. And investors who are buying the world's most popular cryptocurrency now have some very famous friends. Well, Wall Street famous. Earlier this week, billionaire investor Stanley Druckenmiller told CNBC that he too now owns Bitcoin.
I'm a bit of a dinosaur, but I have warmed up to the fact that Bitcoin could be an asset class that has a lot of attraction to it as a store of value to both millennials and the new West Coast money. And as you know, they've got a lot of it. It's been around for 13 years, and with each passing day, it picks up more of its stabilization of a brand.
Bitcoin has been on a tear this year, more than doubling in 2020 alone. CNBC's Kate Rooney can explain what's behind the surging prices.
Analysts are saying that somebody like Stan Druckenmiller getting into crypto has been what a lot of people needed, and that confidence boost for some more mainstream investors to have cover, as they call it, to have confidence to invest in Bitcoin and not feel like it is this crazy out-of-the-box investment. It just makes it more mainstream, and having big names like Druckenmiller, Bill Miller, and Paul Tudor Jones getting in have just made some institutional investors feel slightly more comfortable. It topped 16,000 today, and analysts are pointing to a few other factors as well. So the big argument for buying Bitcoin is that it's a hedge against inflation. So in this environment, if the dollar is weaker and worth less and less stable, folks are going to look to other currencies, and they see Bitcoin as well as things like gold as a more stable bet because there's a certain amount in circulation and it's uncorrelated to some of those other assets like the US dollar, for example. MicroStrategy and Square added millions of dollars of Bitcoin to their balance sheets this year. Square CEO Jack Dorsey calling out Bitcoin on the earnings call last week specifically as the native currency of the internet. PayPal also announced its crypto offering in recent weeks and accelerated that today, saying that the product would be available to PayPal customers on Thursday. So for PayPal at least, they may end up solving one of cryptocurrency and Bitcoin's biggest problems to date, which is utility. People can buy Bitcoin, but people can't really spend it on things like coffee. So a company like PayPal getting into crypto could potentially make it a lot more mainstream and easier to use for everyday payments. PayPal is also letting people buy and sell cryptocurrencies similar to what Coinbase does, for example. Finally, COVID has accelerated the digital economy. Digital currency could make more sense for investors in this environment.
Okay, time for today's numbers round. Let's kick it off with 5. Deutsche Bank strategists are proposing a 5% tax on employees who work from home once government-mandated measures end. Here's their argument. These analysts say that people who work remotely save money on commuting and food, no more coffee on the way in or ordering lunch, and on social outings like office happy hours. That means these workers are contributing less to the economy and potentially slumping national growth. Deutsche says under their plan, the tax would be paid by the employer if they don't provide an office environment for the staffer, and then if an individual decides to start working from home because it better suits their lifestyle, then he or she would be taxed directly. Next is 30. Most Wall Street staffers will see their 2020 bonuses decrease by up to 30% compared to 2019. That's according to compensation firm Johnson Associates. End-of-year compensation, which could be cash or equity, meaning stock, is expected to decline 15 to 20% for investment bankers and 25 to 30% for retail and commercial bankers. But one group of financiers is actually set to get bigger bonuses this year: traders. Fixed income traders who buy and sell government and corporate bonds can expect their payouts to rise by 40 to 45%. And equity traders, again, those are just stock traders, well, they're on track for a 20 to 25% increase in their awards. And finally, 400. Costco is best positioned for the Christmas season, according to one Wall Street firm. Analysts from investment bank Oppenheimer said that the big box store is their favorite retail stock for the holidays because it stands to benefit from strong consumer demand for all things from food to paper products, electronics, and home goods. I mean, it makes sense since Costco basically sells everything. Costco stock is up about 30% since the market lows in March, and these analysts say that it can rise even higher. They have a price target of $400 a share, which is roughly 7% higher than where they were trading at yesterday's close. That's it for After Hours, but before we go, here's one more thing to keep an eye on. Disney reported quarterly earnings late this afternoon, and streaming was front and center. Disney's streaming service, Disney Plus, surpassed 73 million subscribers, absolutely blowing away expectations for its first year. The company itself only projected to reach 60 to 90 million subscriptions by 2024. There's a lot more to dig into in Disney's earnings, including projections for its struggling parks business as the COVID-19 pandemic tightens its grip on the U.S. We've got all angles covered. Get the latest by going to CNBC.com and downloading the CNBC app. We'll be back here in our home office every Tuesday, Thursday, and Friday with a new edition of After Hours, so be sure to catch us then.